We also did the strategy back test on the weekly income double calendar. And so what you'll see here is same 3-year study using SPX. You can see the 7 days to expiration is where we sold the 40 deltas, and then the 21 days to expiration is where we bought them. Again, we put these on daily, so we put one on every single day just to get up the number of occurrences. We exited with 1 day to expiration or 25% of that debit paid. Again, we're not managing these at a percentage of max profit. If we get to a loss of 25%, that's when we are taking these off. And before I move on, I just want to clarify that because I clarified it on the Iron Condor, but I also want to clarify it here on the double calendar. So if we bring up our calculator here, remember, if we're getting in this for $24.75, 24.75 times 0.25, the 25% of that is $6. So if we're down $6, so if we get down to about, remember we're buying this, we want to sell it for a higher price. If the value of the spread gets down to about $18, $6 less than this, that's when we're going to close it. So the actual risk, if you're doing one contract and you pay $24.75 for this, the risk is about $618. Okay, so if we look at this from a standpoint of where we're at, we bring our price slices out here to about $600 and some dollars. That's where price would have to get before we close out the trade, and then the same thing on the downside, about right here. Now that's going to fluctuate as you go through time, as you get closer to expiration. But just to get a kind of a visual picture of where price would need to move before you exited from a stop loss perspective, that's how you want to kind of look at that. All right, back to the back test. I just want to make sure you're clear on that. Exit at 1 day or 25% of debit paid. Here are the results. Average P&L per trade, $155. P&L per day, almost $29. As you can see, using a lot less capital. Even putting one of these on every single day, the most capital required was about $10,522 based on that $100,000 account. Lower drawdown. I mentioned I like these a little bit better. The drawdowns are a little bit less. The required capital is a little bit less. It's a little bit less risk and still performs extremely, extremely well. And the win rate is pretty close to being the same. Like I said, statistically from our own real-life trading, we're closer to about 60%. But the back test compared to the Iron Condor is pretty similar, about 55% on the win rate. Same thing for NDX. Obviously, bigger profits, bigger P&L per day, but you're using more capital. It's just a bigger product. Again, not quite as liquid, and so we don't really trade this one as much. You can see the win rate's a little bit lower in this particular backtest study, but you can see nice equity curve there as well. And then RUT, the smallest of the three, RUT, average P&L $97, P&L per day $16.46, much lower required capital, much lower drawdown, great equity curve on RUT as well. In this case, a little bit lower percent profitable in this 3-year period. Take that for what it's worth. We're just trying to give you an idea of kind of the performance of this. And between RUT and SPX, like I said, we're averaging about 60% winners.